Good morning, Mr. Dan Pickering. Thank you very much for doing this.
Glad to be here, Trevor.
For the listener, you're the founder and chief investment officer of Pickering Energy Partners. But to start from the top, what is Pickering Energy Partners?
Yeah, PEP or PEP, Pickering Energy Partners. We are an energy financial services firm. We're headquartered in Houston. We've got folks basically all over the U.S. And we are focused on the energy business, both the conventional or traditional energy business, as well as all the new energy stuff. We've got 4 divisions in our business. We have an investments business where we're deploying capital. We about equally split $1.5 billion between public and privates across upstream, midstream, OFS, and energy transition. We've got a research business where we cover companies, buy, sell, or hold recommendations on about 85 stocks, as well as energy stocks, as well as kind of the energy macro. We've got a consulting business that does kind of traditional strategic advisory consulting work for energy companies. And then we've got an ESG business on the consulting side that helps companies with all the stuff that's happening in ESG these days. And then finally, we've got an advisory business, investment banking business, where we're raising capital for energy companies, as well as helping them with any kind of M&A processes. And that spans both the energy transition world as well as conventional energy. So that's PEP in a nutshell.
How'd you get into energy in the beginning? I think you're an engineer by training. I
am, Trevor. So I'm a petroleum engineer. My running joke is that you would not want me anywhere close to a live well these days. I graduated in 88, so I'm dating myself. I graduated in 88 with a petroleum engineering degree and spent about 4 years in industry up in Alaska. Pretty quickly knew that that was not going to be the long-term career path for me. And so I left the engineering side of the world, went to business school, and then kind of made my way over to the financial side of energy after business school.
Nowadays, would you describe yourself as an investor or an entrepreneur, an engineer, business owner? How would you describe yourself? Entrepreneur?
Yeah, all of those things. I love investing, and that's one of the key parts of our business here at PEP. And I've been putting money to work in energy companies, since my first gig out of business school was at Fidelity Investments, where I was the energy analyst and ran a couple of the sector portfolios there. And so I've been, putting money to work for 30 years in the oil patch. So yes, I'm an investor, entrepreneur. This is sort of my 3rd or 4th startup gig, if you count building out a research business at Simmons Company way back in 2000 well, actually 96. So the answer is entrepreneur, yes. Investor, yes. Businessman goes along with the entrepreneurial piece, I think. Analyst, always trying to think about analytically what's happening in the oil patch. You can be an advocate or you can be an analyst. I'm much closer to being, I like being an analyst, figuring out what's going to happen, not what we wish would happen. Those aren't always the same. So wear a lot of different hats.
Did you spot a hole in the market for a kind of all-encompassing energy services firm, or why go down that route?
Great question. So in 2004, when I started the original Pickering Energy Partners, definitely there was a hole. That was at the point where research, there was a big focus on independent research, and there weren't many energy firms that weren't directly tied to an investment bank of some sort. And so we thought that was a gap, and we moved to fill it. Good timing. That shale came along in 2007 and really changed the business, grew the business a lot. And so that was clearly a gap. Right now, today, if you looked at the current version of PEP, are there people doing what we're doing? Absolutely. And the way I tend to think about this business on the financial side is that it's generally, just like many other sectors, it's generally overbrokered or overbanked. There's plenty of people playing, although fewer, right? We've had people leave because they didn't want to be in oil and gas. So there aren't as many as there used to be, but there's still plenty. The reality is, in our business, it's a people business. You just got to be better. If I can be a top 5 energy broker, energy investor, energy advisor, I don't need to worry about who I'm pushing off the bottom end of the spectrum. So the gap is, there's always a need for, smart, educated, thoughtful people. And that's a gap that we're trying to fill, every single day.
To bleed if your investors bleed, so to speak, to create a symmetry of risk, did you have to invest much of your own money into the company to align incentives?
Yeah, great question. So the answer is yes. The biggest investment that I have, as part of my net worth is in PEP, the business. And then I'm invested in every single product that we have clients invested in. So all of our funds, I'm an investor in. All of our SMAs, I'm an investor in. All of our private investments, I'm an investor in. So, you got to eat your own cooking. Otherwise, how do people trust you? And I think it also helps. You give good advice because you're thinking like an owner, not thinking like a middleman. So I think it's important to have skin in the game.
One critique of the all-encompassing energy services firm is there is at times a kind of your alignment is sacrificed when you are advising companies and doing M&A and investment banking and everything all under one roof. How do you make sure that you're not compromised in that situation?
Yeah, absolutely. Our firm, like all firms that have these, multiple businesses, we've got a rigid compliance system that makes sure that we have things walled off and have, kind of appropriate information barriers, et cetera. All of that those are the mechanics of the process. The reality is, if our clients don't trust us to do the right thing in every situation, they're not going to work with us. And so, the real governor of the dynamic is if you're misaligned and taking advantage of one client for the benefit of the firm or for another client, you're not going to last in this business. And, I've been doing this, in this format since 2004. And so I feel like we've proved, again and again, every day that we can manage those conflicts. They're there. You got to manage them and you got to put the clients first.
In the inevitable situation that a conflict does come up, how do you deal with that?
Yeah. So typically our existing, when a conflict comes up, it's typically because we have an existing client or an existing situation where a new situation has the potential for conflict. And so typically what you do is, if you can't solve with information barriers and Chinese walls, et cetera, you just can't take the new work. So, your current and existing clients come first, the new situations come second. We work hard to try and make sure that we can accommodate all our clients. But in those situations, you have to say thanks, but no thanks to the incremental work.
You've seen a lot of deals, a lot of investments, a lot of companies, all aspects of the energy business. From your perspective, at this point in time, what makes a good energy investment to you? Is it quick return on cash? Is it steady dividends, increase in share price tomorrow? What makes a good, or is it good rock? What is it?
Yeah. So ultimately, there are a couple of things that are critical to an investment in energy. One's the asset itself. You said good rock. That is always helpful. It's not always necessary, because in a runaway upside commodity tape, a bad rock can get economic fast. And so, marginal economics can become acceptable and good economics really quickly. So sometimes the tier 3 can be the most profitable thing. But the reality is, so you've got to package the asset itself with the macro environment. And so it is always hard to make money when the macro is working against you, when commodity prices are weak, et cetera. And so, we tend to be through cycle investors. What you try to do is you try to find opportunities that make money at a normalized commodity price. I think that's important. Can it make money on an average commodity price? And can you stress test it in periods of weak commodity prices? So what that tends to mean is the capital structure is really important. And so we don't put a lot of debt on any of our investments on the principal side of things because, what looks great at $65 or $75 oil looks awful at $45, and leverage takes away your runway. Leverage takes away your breathing room. And so I think financial structure is really important. The asset's really important. Where you are in the cycle's really important. And in rare instances, all three of those things come together. Most of the time, you're either in things are getting better or getting worse. They're very seldom stable, and so that's where the asset quality really matters. So I put those three things together, and then finally, we do a lot of investments alongside partners, whether it's another financial partner or a management team, or another operating partner. And so alignment of interests, making sure that when they make money, you make money, and vice versa. You don't want anybody in the process to have cross purposes. And so alignment is also really important.
Seems like the best energy companies are kind of a balance between good rock and capital allocation skills, like maybe a Mike Rose in Canada at Tourmaline. How do you kind of find those people? Is there a kind of a screen you have, or do you kind of look for the technical and then you can learn the capital side, or how do you approach it that way?
Yeah. So if we were back in 2007 or 2008, when shale was just kind of getting going, for instance, the technical side of things would be paramount, right? You didn't have as much knowledge about basins and where good rock was and where tier 1, tier 2, tier 3 was going to be. You had a business that was a lot more on the upstream side, a lot more focused around exploration activity, where you're taking risk for, hopefully outsized returns. So I think when I think about, that question, we're now, there's a body of knowledge about kind of the basin specific opportunities and, what counties and what areas are the right spots and what are a little bit more fringy. And so having that as sort of a baseline of knowledge is the starting place. And then you've got to hone in on the specific opportunity set in today's world in shale, where you're almost certainly going to be doing things where there's a lot of offset activity. Really understanding the nearby well results is important. Geology, you want to understand that. And then you've got to have, I think, a good understanding of how you want to actually develop, your asset base. And that's a combination of the pace and how you drill and complete wells, what kind of lift mechanisms you put in place as you're, maturing that well, et cetera. So it's always technical, and it moves from the technical then to the financial terms and structure. When you're thinking about deals, you always have to start with rocks.
A lot of the best investors will describe their process as a craft, the investment kind of decisions as a gut feeling or a tingling feeling. Sometimes they can't really describe it in a precise formula. Do you get certain feelings, so to speak, with good investments or good teams or good opportunities, or is it all in a formula?
Yeah, it's not formulaic. I mean, if it was formulaic, then we wouldn't need any humans doing it, right? You just plug data into some big computer, and maybe AI is going to make it easier. But we've had computers for a long time, and we still have needed people. I think it's a lot harder to get that spidey sense or tingly feeling, if you will, from a technical perspective. The offset wells are what the offset wells are. Where you do definitely, where qualitative things really come into play is the people you're dealing with, the management team, the operators of the assets, because it's 1 in 10 where all the technical things go as planned. 9 out of 10 times something's different than what you expected technically. And the capability of your partners or the operating team is so important. How are they going to act when things aren't going well? How are they going to bring opportunities to the table? Are these good people? Are they smart people? Are they people with good business sense? Because ultimately, as an investor, we're almost always trusting an operating partner to execute and to deal with us, in a fair way that we want to be dealt with. And so typically, if you've got a good feeling about people, you should trust it. If you got a bad feeling about people, you should trust it. And it also helps, right? You have to have been through this a lot. The first 5 times you see a situation, it's harder to deal with than the 50th time or the 150th time. And so looking at a lot of deals, talking to a lot of people, working through structures with a lot of folks, you get that sense of who gets it, who doesn't, who's going to be a good partner, who isn't. And that tends to make a big difference in those 9 out of 10 times when the technical side doesn't work perfectly.
You have a large book now with lots of capital under management, lots of people working for you, lots of segments of the business, research, investment banking, private placements, various factors in the business. Is there a particular side of the business that you focus more of your time on than the rest that kind of leverages the business more than the others? Or how do you think of it that way?
Yeah. So today, PEP has about 60 people. We got the 4 divisions that we talked about at the beginning of the podcast. And we run about $1.5 billion for our external clients. And we have a lot of constituents, right? We have a lot of external investors in our firm. We have a lot of external investors in our funds and a lot of external clients in all the divisions. And so that's the majority of my time is dealing with people, and kind of whether you're always developing business development is finding deals to invest in. It's helping companies on the investment banking side. It's identifying and solving problems for clients on consulting. And so I get pulled in lots of different directions there. I'd say I spend about a third of my time dealing with and interacting with our people internally and 2/3 externally. And I'd like to do 100% on both, but you can't. And so, I would describe, my challenges as the to-do list never gets shorter. And as an energy firm, we have to be smart in the energy business. And so I've also got to spend time understanding, what's happening in the Permian Basin, or what's happening in the Montney, or what's happening in other areas. So, staying smart is always a job requirement as well, if I was ever smart to start with. But so kind of keeping up with what's happening in the energy patch is another component. It's an important component. And in the last 2 or 3 years, that has expanded, probably past 5 years, that's really expanded because now it's not just oil and gas and coal, it's nuclear and hydrogen and carbon capture and wind and solar and energy storage and electric vehicles. I mean, the list goes on. And so that's been really fun to sort of understand that part of the business better. And it's growing quickly, but it also takes time. So, you got to manage those time constraints.
Are you seeing emerging opportunities in the renewables and kind of clean tech environment, or is it still kind of nascent where maybe returns aren't there yet, or are you thinking of it more nowadays?
Yeah, it's a great question, Trevor. I think I'm going to answer. I think the answer to that question depends on what kind of investor you are. And so I view myself as more of a public markets and private equity type investor. And so I think about returns and my return criteria as, I need to be making 15 to 25% a year, something like that. And when I look at some components of the renewables business, wind and solar, I don't think you can make 10 or 15, or 15 to 25% rates of return. On a levered basis, you might make low double digits. It's very competitive, and it's an infrastructure play. And infrastructure monies, they're looking for 12% levered. And that means they're doing projects that are 9% or 8% unlevered. And my personal view is there's not, on a risk-adjusted basis, there's not an energy project in the world that's worth doing for a single-digit return. It takes one turbine blade problem, one winter storm problem to wipe out a bunch of your return. So my view is some of the areas that are growing the fastest are also the most competitive. And so you've got to be looking for niches. I think that the renewable business will have cycles, just like the traditional energy businesses have. And there'll be fabulous opportunities to get great assets when people hate them, or when they've been over levered or had problems, or the government cut subsidies, or who knows. Today, returns are just a little compressed in that component of the business. So always risk adjusted is how I think you got to be thinking about it.
Yeah, 15 to 20% annualized return is phenomenal. If you can compound that for a long period of time, would that be maybe your value proposition to investors who do have options in the markets, that maybe you can provide that extra little bit through your experience in the energy sector?
Yeah. So the answer to that question is I wish. In private markets where you are by definition long at all times, and most of our strategies are long only strategies, and so they're much more episodic. If you looked at 2007 to 2014, compounding at 15% was quote unquote easy because shale was going crazy and there were lots of places, growth businesses was really exciting. 2014 to 2021, the answer was don't put a dime in energy. And so that goes back to, on the private side, our philosophy is you got to find good assets, and then you got to put the right structure on them, and you can work through that and hopefully build your asset base during down cycles. On the public markets, there's times to be long and there's time to be gone. And so that 15 to 20% long only compounded rate of return is, you'd love to do it. It's damn hard to do in a cyclical business. And so we tend to guide our clients when things get frothy. The answer is take money off. We don't try to change our stripes and be a long short shop when cycles get longer in the tooth. The good news right now is my personal view is we've got a period here after 7 years of underinvestment that, on the conventional side of things, my current outlook for oil price, for instance, is $80 for the next 5 years. I mean, I've never had a price objective that high or for that long. And we've got OPEC protecting us. We've got underinvestment, which is protecting supply. Folks are scared to get aggressive because, one, investors don't want it. Two, they're worried about peak demand and energy transition, et cetera. And so it's just a great setup for a pretty good commodity price, which translates to a great setup for profitability for companies. And so now is, in my opinion, a time to be long the space. I don't want to hedge, because I don't think, when I look at my screen in 2025, oil is $67 or something like that. Actually, sorry, $72. It's come up a little bit in the last couple of weeks. But I think there's another 10% to go in oil price and another 50+% to go in stocks. You want to be long in those periods.
The critic, I guess, from the quality sort of tech space, or whatever you want to call it, growth space, would be that there's no catalyst to increase the value of the energy share prices these days, and that there may be a value trap. In your opinion, is profits the cure all to that, or what brings the energy shares up in the public markets?
Yeah, so it's the commodity, it's the duration of the commodity, and it's the behavior of the companies. So you're right. The critic would say nothing's happening in energy. And that was true for the first part of 2023. I mean, oil prices came down, flattened out in the 70s. But we've now got to pop back up into the 80s for crude. May or may not stay there, but I think the commodity is constructive. So that's point number one. Point number two is this duration issue. If I can look out and think that I'm going to get $75 to $85 crude for the next 5 years, that is a ton of cash flow. Mm-hmm. And then what are the companies doing with it? Well, they're reinvesting, but they're reinvesting to grow 1% to 3%, not reinvesting everything they've got, which translates to a bunch of share repurchase. Debt pay down has been significant. The balance sheets are really repaired here. So I don't have a ton of financial leverage or risk in the space right now. And the companies have kind of committed to being good actors. So, yep, when NVIDIA blows out the quarter and all the money rushes to tech, energy is going to lag. I think we're going to wake up in 3 or 4 years and these companies are going to have cash flowed anywhere from 30 to 100% of their market cap and given back a big chunk of that. And if that's the case, the stocks simply can't trade here. They can't trade at 3 or 4 times cash flow. They can't trade at NAVs that reflect $65 oil. So patience is one of the pieces. And I don't need a catalyst if I'm going to wake up in 5 years and have, the companies be half the size because they bought back half their shares. A catalyst is nice. I'd rather get paid faster. And that tends to be the way it works. Energy was huge in 21. It was huge in 22. It's been a dog in 23. It'll have its period of being huge again. And guessing when the market comes around is hard. And so I'd rather just sort of be there and wait and decent dividend yields while you're waiting.
In Canada, the industry has moved towards the capital allocation kind of strategy. Sounds like that may be the case in the USA as well. But on the other hand, do you ever worry that not enough money is being spent on organic growth and that a lot of the big finds is really what creates the massive wealth, like a Harold Hamm or a Mike Rose at Tourmaline, that's really where the organic value creation is through the massive discoveries? Do you worry that not enough money is being spent in that space, or is it just kind of a stage of the industry?
Where I would worry is I don't worry about, the value creation per se, because that's a byproduct of kind of the underlying macro backdrop. Where I worry, and we saw this a little bit in the past couple of years, where you worry is when the market tightens and commodities, it doesn't take much, not enough, price can go up 50%, too much, price can go down 50%. Where I worry is $5 gasoline did a lot of things. It created demand destruction. Mm-hmm. People use the commodity less. It created government reaction. Windfall profits taxes in Europe. It created release of the SPR in the U.S. And so you look at those things, and I worry that underinvestment translates to potential scarcity of supply, potential spikes in price that are not healthy for the long-term, dynamic of the business and not healthy for consumers. That's what I worry about. I do think that as we see this duration of commodity price, right, the world's kind of moved away from wildcatting as shale happened. I mean, shale became the big value creation process. The shale market's much more mature, plateauing in some basins. And so what we're seeing is consolidation. Companies are buying each other. If they can't, shareholders won't let them grow organically, they'll grow inorganically. I think that's happening in Canada as well a little bit. But the other thing that inevitably comes out of a maturing of your growth opportunities like shale is that you start going back to some of the good old-fashioned oil business, looking for new plays. Exactly. And some of that's going to be shale, some of it's going to be conventional. And there's nothing better than spending $5 million to drill a well and finding $500 million worth of resource.
Yep.
We haven't done a ton of that in the last decade. Energy transition and net zero scares people from making these big longer term investments, but exploration is picking up again. And you're seeing that offshore, deep water activity has picked up. These guys have to replace resources. You can drill big reserve opportunities offshore. And I think we'll see it domestically, meaning onshore, North America in the next 3 or 4 years. Is my expectation is there will be more risk dollars put to work, and there will be more kind of consolidation that allows companies to grow without growing the aggregate, right? They grow themselves even if the overall production pie is not growing.
In Canada, it's become a little bit harder to be an energy entrepreneur with the resource plays and the mature basin and horizontal wells. Everything's so expensive in the US. Have you seen similar trends? Is it become more difficult to become an energy entrepreneur, or is it just changed, or how do you think of it?
Yeah. So there are still people out there with $5 million drilling conventional wells that cost $500,000 or $1 million. But if you look, the bulk of entrepreneurial activity it's coming with much bigger check sizes. So it tends to be around these resource and shale plays where wells cost $3 to $20 million a piece. And so an acreage is expensive to acquire. And so what we're seeing is, kind of the rise of private equity. And, today, entrepreneurs versus taking some of their own money and friends and family money and bootstrapping their way through small wells, they're going to InCap and Quantum and, others, ArcLight, et cetera, and they're raising hundreds of millions of dollars to go out and do these bigger programs. So I think it has become a game of, it's become a bigger ball game. And so the stakes are much higher, both success and failure. And by definition, what that means is the number of new companies and the number of sort of wildcatters has dwindled as it's gotten more concentrated and the dollars have gotten bigger. Will that expand back out? Maybe. But I think the game for the foreseeable future continues to be more expensive wells, not less expensive wells, probably.
The shift has moved away from energy in a lot of ways into tech and kind of other fast money sort of, I guess you could say, sectors and whatnot lately, which on the other hand, maybe has created mispriced opportunities. Are you seeing mispriced opportunities in the energy sector now? And is that maybe a good thing for you?
Yeah. So what I would say is there's still enough capital out there that it is no longer a seller's market, but it isn't a $100 bills laying on the ground, to pick up buyer's market either. So I'd say it's a pretty balanced market on the private side. I think public companies look, inexpensive to me relative to kind of their potential. So I would say that the stock market has left the energy sector behind more than the private equity market has. The challenge on the private side is that when you're trying to exit, there are fewer public buyers. Those public buyers are guarding their currency a little bit more aggressively and trying to strike tougher bargains. So I think it's a pretty balanced market on the private side, and I view the public side as inexpensive, particularly given how quickly sentiment can change. Sector rotation can happen fast.
As a US-based investor, I think most of your portfolio is based in the US, but you also have exposure to Canada being so close. How do you view Canadian energy? Do you see it as a risky bet with politics being involved, or do you see mispriced opportunities, good regulatory environment? What's your view of Canada coming from Houston?
Yeah. So I think every local market views, their own challenges, political, regulatory, et cetera. It's like, oh, people don't understand how hard it is. And the business is hard everywhere, without a doubt. What's interesting to me about Canada is on the public side, and in some instances, the private side, it's trading cheaper than the US. It's got a lot, it's more fragmented, smaller company market generally. And so I actually think that we're going to see more cross-border action in the next 4 or 5 years, because if companies are going to be less focused on their own very small specific areas. So in the last decade, as shale took over, folks became shale players. Then they became gas shale players. Then they became Marcellus shale players. And then they became, Butler County shale players. They got very, very focused. What we've seen is now that those shale plays are starting to plateau and companies are still looking for growth, they're starting to branch back out again. We've seen a few deals in the US where oil companies have merged with gas companies, for instance, to create a more diversified portfolio. When that starts happening, and I think it will continue to happen here in the US, companies start looking for value. Where are things inexpensive? I'm less concerned about only being a Permian player or a Bakken player, and they're more concerned about, how do I get attractive resource? And so to me, I think Canada looks very interesting from that perspective. Notwithstanding, there's always frustration with regulatory environment, et cetera. The kind of environmental and green movement that we see in Canada is a little bit stronger than it is here in the US. Those are surmountable challenges, and cheap opportunities or growth opportunities, can go a long way to offsetting any potential perceived negatives. And so that's really a long-winded way of me saying, Trevor, that I think Canada's, to the US investors, getting increasingly more interesting. And the valuation gap's probably too broad. You're seeing some of the heavy oil transactions. The US folks are buying, Conoco's buying some more Canadian heavy oil, for instance. So I think we'll see more of it, and it's an interesting spot, but these things don't happen in 2 weeks or even 2 quarters. And so I think it'll be a gradual reintegration of North America.
Warren Buffett would say one of the main jobs of a CEO is capital allocation. When deals start to happen, do you worry that although assets may be mispriced, that the deals aren't done correctly? For instance, it's easy to blow your share count and just buy a company. And if you're watching a CEO, how do you make sure that the deal is done correctly? Do you have to kind of pound your fists and make sure that things are done right?
So 2 or 3 ways to think about this, that as an investor in public companies, you can do one of 2 things. You can be loud and advocate for what you think is the right deal if someone's doing a wrong deal. Or you can sell your stock. Most investors simply just sell their stock and move on to the next thing. And so, the key, I think, is companies you invest in, you have to have an ongoing dialogue with them about what you think the right answers are. And so, as they make choices, at least they're informed. And PEP is a small investor in these companies. The Fidelities and the Capital Worlds, et cetera, are the big players, and it's important for them to have those dialogues. Then you've got a relatively vocal community. Cambridge is somewhat activist around these topics and write white papers on the topic. Our asset management group, Sailing Stone, at times has been quite vocal around how they want to see companies allocate capital. So I think the key is investing in companies where you think they're going to do the right thing. When they do the wrong thing, most people are going to go away, turn it over to the ARBs, et cetera. And so it really comes down to understanding your investment and making sure that you think the assets and the team are going to sort of act in a manner that you expect. If they surprise you, it becomes a lot harder choice.
You see a supply crunch these days. Is it the narrative or is it true?
It is an intermediate term narrative and truth. Global inventories have risen in the last 6 months. And so that would imply that we don't have a supply crunch. We were at pretty low levels. We've come up some. I think that we have a much tighter situation facing us. OPEC's got barrels off the market. Shale volumes are not surprising to the upside. So they're kind of coming in line with expectations or a little bit below. And so a crunch, you can call it a supply crunch. The reality is it's always a function of how supply and demand interact. And the one thing we've seen this year is that the demand side of the equation continues to sort of, it's improving. It's not improving as fast as people thought. And so, China's not as good as had been expected. And so the market tightness is a function of both supply and demand. The supply side, I don't worry about. If we look forward 3 years and oil's 60 or 50, we've had a demand problem. And by the way, the whole world's been worrying about this, demand problem, recession, global recession, interest rates, et cetera, for 2 years. And we soft land this thing, hats off, that'll be amazing. If we don't, demand's not going to go down 10%. It'll go down 1% or it'll be flat. And that keeps oil from going to 100. I don't think it makes oil go to 50. So particularly with OPEC being pretty disciplined and particularly with the relatively low level of investment we've had. So the supply side feels to me like it's helping create a floor. And is it a crunch? It's not a crunch right now. A crunch is $120 oil. We're not there yet.
Like you said, that certain people have been calling for a recession the past year or maybe two, and yet the markets are strong. The economy seems to be doing pretty well and everything's going fairly well. As a chief investment officer, do you find that things like the yield curve and I guess commentary is helpful in making your decisions, or have you found those tools to be not worth your time, or do you pay much attention to stuff like that? Because for the last 2 years they've been wrong.
I talked about important things in energy investments. It's the asset, it's the structure, and then it's kind of where you are in the cycle. So I think if you take that up to the macro, the big global macro, if you ignore that and get it wrong, you'll wake up, with a big headache and say, gosh, I wish I would have, paid more attention to fill in the blank. And so I think from a CIO perspective, from a portfolio manager perspective, frankly, from a business perspective in the oil patch, if you're not thinking about the risks that are potentially present, you're asking to get run over by them. And so, for instance, we could make more money and better returns if for the last 3 years we've been 2 times levered in our investments. And that all works until it doesn't. And as we have seen numerous times, things can turn quickly, like oil can go from 80 to 50 in months. And so that's the answer is being prudent helps you stay awake, from staying awake at night when some of these global macro things come into play. So your portfolio and the strength of those companies is always your kind of comfort, and it lets you then be moderately concerned about the big picture instead of laser focused. What am I going to trade today? Literally today, August 8th, the China import data looked bad. China's second biggest consumer of oil in the world. We care about what's happening there, and it doesn't look great. Hasn't looked great for a while. We think it's going to get better, but it hasn't gotten better. And the world seems like it might make it worse. And, all these rapidly rising interest rates make money tighter, and seems like there should be problems. And so, I think you have to be cognizant of that. This market feels to me a little bit like 2000, 2001 kind of internet bubble, tech boom kind of thing, where valuations blew out, and it didn't matter until it Eiffel Towered, right? It was like, great, everything's fine, everything's fine, everything's fine. And there's like, holy cow, I can't sell them fast enough. So there's a tinge of that right now. Am I changing how we invest day to day based on that? No, but somebody shows up and says, we need to borrow a bunch of money against our positions. I'm thinking about it and generally trying to say no to those kinds of things.
One problem in the energy industry is that people, as energy investors, are by definition biased in that they want $100 oil, they want $120 oil. How do you protect yourself against that kind of thinking? Do you kind of just start at the balance sheet with low debts and to keep things conservative to make sure you're not reaching, I guess, so to speak?
Yeah, I think when times are tough, it's easy to be conservative. When times are good, that's when it's hard, to not hedge. Or to stop hedging. So if you look at public companies, they're terrible hedgers because they get optimistic and they don't hedge or take their hedges off. Then things get bad. Their banks or their shareholders are scared, and then they request hedges. And so a lot of times they're basically timing it incorrectly 3/4 of the time. Exxon doesn't hedge at all, never. So they can't be wrong. I mean, their timing can't be off. We tend to be hedgers fairly consistently, 18 months out, a year out, so that taking those off or not doing it, that's going to be the tough part. So it's when things are bad, it's easy to be conservative. When things are great, that's how aggressive do you want to be? And so it's discipline in the good times that I think is actually harder, and that costs you something until you have your inevitable change in the cycle. So, my view is you want to be aggressive. Warren Buffett saying, right? Be nervous when others are fearful, and vice versa. We're in the oil patch right now. We're on a scale of extreme fear, extreme greed. I think the entire complex is a 4. It's not an 8. And so to me, that makes me much more optimistic. And when we get to an 8, that's when you have to start thinking about who could I sell to, right?
Right.
So we're not there yet.
Well, I know you don't have all day. Maybe we'll do a couple more questions, and that will be it.
Great. Good dialogue. I'm enjoying it. So hit me with the toughest 2 you got.
Best energy investment you've ever seen.
The best energy investment I have ever seen. You go back to, I'm dating myself here, but the best energy investment that I've seen, this is one of them, it's hard to pick, but you talked about exploration and success in wildcatting. So if you go back to the days when Jim Flores and Billy Rux formed their company, Flores and Rux, it was probably $100 million market cap company at the time. What were they doing? They were buying old, neglected assets from major oil companies. They were going in, doing repair and maintenance work and enhancing the wells that way. And then they were drilling around with 3D seismic. That was such a great story because you had a favorable cycle happening. Prices were improving. You had assets being shed, neglected assets, and you had new technology that you could apply to them. So that would be one example. The modern day examples, there are a number of, InCap early on. InCap is a private equity firm here in the US. They backed a number of entrepreneurs to go out, grab acreage, drill a few wells, and flip. There were, 10 baggers in 2 years around that. And so, the consistent theme here is grabbing an asset that's either underappreciated or underexploited and doing enough that it shines the light on the quality of the asset, and then hopefully somebody shows up and doesn't just pay fair value, they overpay. So those would be two examples of the best investments that I've seen in this business, and it's the ones that you're always looking for.
Advice to an entrepreneur or a young person in the energy industry, what would you tell them?
Ooh, that's a good one. So I'd say a couple things. As a young person being entrepreneurial in the energy business, I think, one, it's okay to be entrepreneurial in the oil and gas space, because I think we got 50 years worth of exploitation of hydrocarbons, notwithstanding net zero and all the stuff that's happening around decarbonization, because we use 100 million barrels a day of oil. We're not going to be using 0 barrels a day of oil anytime soon. So I think it's okay to be entrepreneurial in traditional hydrocarbon energy. That'd be one comment. Second comment would be that there is secular growth happening in new energy technologies, energy transition, decarbonization, et cetera. And so risk reward there is dramatic. You may have 100 bagger. There are going to be dozens of $50 billion energy transition, energy technology companies. And there are a couple right now. So that's out there for the taking. And there are a gazillion zeros that are also out there for the unlucky. And so high volatility, I think, on new energy, lower volatility in traditional energy. I think the other comments I would make are pick your partners wisely, both your capital partners and your operating partners, the people you work with every day, because things won't go perfectly, and both sets of people, your teammates and your money, has to stick with you. And I think the other piece of it is that at the end of the day, you always be curious, and you cannot ask enough questions. You cannot spend enough time, talking to your peers, because you're not going to have all the smart ideas. You can learn a lot from others if you just ask them and communicate with them.
Well, that's awesome. I think that's a good covering of the waterfront from Pickering Energy's perspective. I really appreciate your time. Thank you.
Trevor, enjoyed it. Thanks so much.
We can end the formal conversation there. So.
Sounds great.